The global financial system constantly shifts under the weight of unexpected events and persistent economic challenges. Observers note that times of great uncertainty often force individuals to reevaluate their assumptions about wealth preservation. These complex dynamics require careful attention to understand the true trajectory of precious metals. Lorenzo Portelli from the Amundi Investment Institute recently shared an insightful analysis regarding the future path of gold. He serves as the head of cross-asset strategy and provides deep perspectives on macroeconomic trends. His team firmly believes that gold possesses substantial room for significant upward movement. The recent research report explicitly targets a price of $5,500 per ounce within the next 12 months. This optimistic projection emerges despite recent periods of downward pressure and market consolidation. Institutional experts maintain that current fundamentals strongly support a sustained rally over the coming year. Recent trading weeks witnessed a noticeable drop in gold values as global tensions escalated sharply in the Middle East. The outbreak of war involving Iran triggered immediate reactions across various commodity sectors and financial exchanges. This geopolitical shock created a temporary headwind for traditional wealth preservation strategies. Many investors naturally expected gold to surge immediately following the onset of such severe regional hostilities. Instead, the market experienced what some experts described as a temporary failure of the expected safe haven response. Prices fell roughly 15% from the record highs established earlier in the year. This unexpected decline stems directly from the rapid increase in global energy costs caused by the regional conflict. Surging crude oil prices immediately elevated concerns regarding a massive resurgence of consumer inflation across developed economies. Market participants quickly adjusted their expectations for future monetary policy decisions accordingly. Investors feared that central banks would need to maintain elevated interest rates to combat this new energy-driven inflation. Higher interest rates typically create significant pressure on assets that do not generate regular yield payments. This specific mechanism explains why gold struggled during the initial stages of the war. Lorenzo Portelli argues that this market reaction represents a technical repricing rather than a fundamental deterioration of gold. He emphasizes that the inflationary boost resulting from these sudden energy supply shocks will likely prove temporary. The fundamental investment case for precious metals remains exceptionally solid and thoroughly intact. A deeper examination of current inflation statistics provides crucial support for this optimistic institutional viewpoint. While headline inflation numbers rose to 3.3% due to energy costs, the underlying trends look different. Core consumer prices exclude volatile energy components and demonstrate a much more moderate trajectory. Core inflation metrics have stabilized around 2.6% over the past 12 months. This stable performance significantly reduces the immediate pressure on central banks to intensify their restrictive monetary policy measures. Authorities recognize that energy shocks rarely create sustained long-term inflationary pressures within the broader economy. The Amundi team anticipates that gold prices will gradually approach their target over time. Multiple underlying fundamental factors continue to reinforce the long-term support for precious metals. Investment demand for these physical assets is not solely determined by United States interest rates. Central banks worldwide continue to aggressively increase their strategic allocation toward physical gold reserves. Emerging market monetary authorities specifically seek to optimize their foreign exchange reserve structures permanently. These institutions deliberately intend to reduce their heavy historical reliance on traditional fiat currency systems. This strategic reserve demand provides a massive foundation that supports higher valuations going forward. The People's Bank of China recently extended its buying streak for many consecutive months. Other emerging nations like Poland and India follow similar patterns of aggressive wealth accumulation. The scale of global sovereign debt continues to expand at a truly unprecedented pace. Fiscal instability across major developed nations reinforces the urgent need for hard asset diversification. Investors increasingly view gold as a necessary hedge against systemic risks and currency debasement. United States annual debt interest costs currently approach an astonishing $1.9 trillion. This massive financial burden severely limits the absolute ability of the Federal Reserve to maneuver. They cannot aggressively combat inflation without risking severe damage to the broader global financial system. This precarious fiscal arithmetic creates a highly supportive structural floor under physical gold prices. Any short-term price weakness driven by interest rate fears represents a strategic buying opportunity. The inevitable return to a debasement-led rally appears virtually guaranteed by these mathematical realities. Liquidity risks within private credit markets are also gradually becoming much more prominent recently. This hidden vulnerability leads to a sustained shift of investment funds toward tangible assets. Professional money managers recognize that physical gold carries absolutely no associated counterparty credit risk. The recent nomination of Kevin Warsh as Federal Reserve Chair introduced significant market volatility. Investors perceived him as highly restrictive, which initially caused a sharp drop in prices. This hawkish scare temporarily cooled expectations for aggressive interest rate cuts during the upcoming year. Despite this sudden leadership uncertainty, the broader trend points toward a more accommodative stance. The central bank officially ended its quantitative tightening program in December of the previous year. This major policy shift removes a massive liquidity headwind that previously suppressed asset price appreciation. Labor market statistics currently show undeniable signs of underlying weakness across multiple vital sectors. Slower economic growth heavily pressures officials to consider implementing supportive monetary stimulus measures soon. Rate cuts directly benefit precious metals by dramatically lowering the opportunity cost of holding them. The ongoing transition toward a multipolar reserve system fundamentally alters traditional global investment strategies. Geoeconomic fragmentation actively encourages nations to prioritize their own sovereign financial security independently. Gold perfectly serves this critical function because no single government controls its global supply. Institutional portfolios previously relied heavily on the standard 60-40 split between stocks and bonds. Elevated correlations between equities and fixed income have severely challenged this traditional investment approach. When both asset classes decline simultaneously, investors desperately require alternative methods for protecting wealth. The Amundi Capital Market Assumptions report explicitly recommends increasing allocations toward tangible physical assets. For multi-asset investors, the role of gold has officially evolved into a structural necessity. It provides unparalleled resilience during periods characterized by high structural deficits and geopolitical rupture. Exchange-traded funds recently experienced a massive resurgence in positive investor capital inflow momentum. Western funds added roughly 500 tons of physical backing since the year began. This powerful institutional restocking cycle significantly tightens the available supply across global wholesale markets. The current accumulation cycle boasts immense potential to contribute further to overall price appreciation. Total holdings currently remain below their pandemic peaks, suggesting the sector is not over-allocated. Fresh capital deployments from retail participants could easily drive spot valuations toward new records. Supply constraints within the mining industry provide another crucial layer of long-term support. Major extraction companies consistently struggle to discover and develop new high-grade mineral deposits. Production volumes are highly unlikely to keep pace with the burgeoning structural global demand. Operational risks, including labor disputes and strict regulatory changes, frequently disrupt existing mining operations. Rising production costs effectively guarantee that the fundamental fair value of the metal drifts higher. Any significant increase in consumption must therefore be met by substantially higher market prices. Silver frequently acts as a highly volatile companion to its more expensive precious counterpart. Following the initial conflict shock, silver demonstrated remarkable resilience by recovering 31%. The ratio between the two metals compressed significantly, signaling a broadening of the current bull market. Strong investment demand for silver continues despite observable contractions within certain industrial technology applications. High prices naturally reduced manufacturing consumption slightly in the photovoltaic, solar, and jewelry sectors. However, massive inflows into silver exchange-traded products completely offset these minor industrial usage declines. When the cheaper metal strongly outperforms, it often indicates a very healthy overall market. Retail investors eagerly participate when they perceive exceptional value relative to historical pricing norms. This broadening participation base establishes a much stronger foundation for the entire precious metals complex. Technical analysis suggests that gold currently occupies a necessary consolidation phase, gathering future momentum. After establishing new highs, the market naturally coiled between well-defined support and resistance boundaries. This specific period of sideways movement is incredibly typical following periods of outsized returns. The reversal band for spot prices currently sits comfortably between two strong technical levels. Analysts continuously watch for a decisive break above the 50-day exponential moving average. A clear breach of this psychological hurdle would officially signal that the rally has resumed. The psychology of the current financial market is aptly described as one of controlled disorder. Unpredictable global shocks generate rapid capital rotation rather than a uniform directional market trend. Gold serves as the ultimate sanctuary because it represents absolute financial independence and security. A generational shift in investment behavior also provides strong underlying support for the asset. Younger demographics demonstrate a rapidly growing affinity for digital platforms and alternative physical investments. The steady rise of tokenized gold assets enhances liquidity and global accessibility for everyone. This fascinating digital evolution of the traditional bullion market introduces entirely new participant classes. Institutional money managers increasingly utilize these modernized vehicles to bypass cumbersome legacy settlement processes. Increased market efficiency ultimately reduces the chaotic volatility previously associated with legacy futures contracts. Many professional financial organizations share the profound optimism expressed by the Amundi Investment Institute. J.P. Morgan analysts confidently set their respective long-term price target at $6,000. Wells Fargo strategists actively recommended buying the recent market dip, citing extreme policy uncertainty. Goldman Sachs explicitly maintains its highly favorable outlook despite the recent geopolitical sell-off. They view the potential risks to their elevated price forecast as asymmetrically skewed toward upside. Their mathematical models assume continuous monthly purchases by central banks across the emerging world. A very recent Reuters poll of 30 independent analysts confirmed this extremely positive consensus. The vast majority of experts project that values will end the year substantially higher. The recent correction merely widened the numerical gap between current prices and ultimate targets. The current period of intense price consolidation genuinely represents a highly strategic entry point. The market has successfully undergone a necessary cleansing of excessive and dangerous speculative positions. This healthy valuation reset leaves the asset completely primed for its next explosive move. As the immediate shock of the Middle Eastern conflict inevitably subsides, focus will shift. Attention must return to the undeniable long-term trajectory of global currency debasement initiatives. The fundamental path toward $5,500 appears completely assured by mathematics. Lorenzo Portelli correctly emphasizes that this target represents the logical outcome of current policies. The global economy is frantically adapting to permanent rupture and desperately seeking verifiable resilience. The ongoing structural realignment of international monetary reserves is the defining story this decade. Physical bullion remains the absolute primary beneficiary of this massive transition away from dollars. While it cannot perfectly hedge against every single conceivable market fluctuation, its utility remains undeniable. It effectively mitigates catastrophic systemic risks and protects wealth against relentless domestic currency depreciation. Short-term price action frequently obscures the much larger macroeconomic realities driving the market. Analysts who fixate solely on daily interest rate movements fundamentally misunderstand the current paradigm. The profound breakdown of historical correlations demands a completely new analytical framework for investors. The undeniable erosion of absolute confidence in Western sovereign debt fundamentally changes portfolio construction. Investors can no longer rely blindly on government bonds to provide guaranteed safe haven protection. Explosive debt trajectories actively challenge the historical status quo of global capital preservation strategies. $4,000 per ounce is now widely viewed as the new absolute baseline. This compares directly to how $2,000 functioned during the previous pandemic era. This permanent upward rebasing reflects the severe damage inflicted upon fiat currency purchasing power. When governments run massive structural deficits, they inevitably rely upon central banks for financing. This hidden monetization process silently confiscates private wealth through the hidden mechanism of inflation. Physical metals provide the only reliable mechanism for completely escaping this insidious confiscatory process. The recent behavior of commercial institutions strongly validates this dire assessment of fiat currencies. Multi-asset portfolio managers are aggressively reducing their historical exposure to aggregate bond indices. They actively reallocate that capital into tangible commodities to build necessary long-term resilience. Dynamic risk profiles now incorporate substantially heavier weightings toward non-traditional wealth preservation tools. This sophisticated strategy acknowledges that future returns require completely different approaches than past successes. Embracing hard assets is no longer considered eccentric, but rather a fiduciary professional requirement. The sheer mathematical impossibility of normalizing interest rates without causing mass defaults is obvious. Global financial systems are completely trapped by their own historic excesses and reckless borrowing. Central planners must choose between protecting the currency or preventing a catastrophic economic depression. History proves conclusively that politicians will always choose to sacrifice the currency to survive. This inevitable political choice guarantees that nominal asset prices will continue their upward trajectory. Those holding physical wealth will successfully preserve their purchasing power throughout this difficult transition. Emerging market citizens understand this reality much better than their developed nation investor counterparts. Countries like India boast centuries of deep cultural affinity for acquiring physical precious metals. They inherently distrust government promises and prefer to hold wealth directly in their hands. This profound cultural wisdom is finally spreading across Western financial markets out of necessity. The rapid expansion of specialized investment funds demonstrates this powerful awakening among retail participants. People eagerly seek reliable protection from the relentless hidden taxation of expansive monetary policy. The path forward requires profound patience and emotional discipline from all serious market participants. Temporary price suppressions engineered by leveraged futures traders must be completely ignored by investors. The true physical market remains incredibly tight and highly responsive to fundamental supply constraints. Lorenzo Portelli correctly identifies the current environment as a truly critical economic inflection point. The intersection of geopolitical conflict and fiscal dominance demands a fundamental strategic portfolio realignment. Traditional economic theories simply cannot explain the complex dynamics presently unfolding across global markets. Investors must deeply internalize the fact that the international monetary regime is permanently changing. The United States dollar is slowly losing its absolute unquestioned hegemony over global trade. This massive paradigm shift directly necessitates a massive repricing of all independent reserve assets. The Amundi Investment Institute provides a highly rational framework for navigating this impending turbulence. Their careful analysis avoids sensationalism, while firmly acknowledging the severe mathematical realities facing governments. The 12-month price target is completely realistic given the immense macroeconomic pressures building. As the year progresses, we will likely witness further dramatic episodes of market volatility. These chaotic moments will shake the absolute conviction of weak hands holding paper contracts. However, those who focus solely on the structural fundamentals will confidently weather these storms. The architecture of financial resilience requires building a solid foundation using proven historical materials. No financial instrument boasts a longer or more successful track record of wealth preservation. The current generation is simply rediscovering ancient truths about the nature of reliable money. We stand upon the precipice of a massive revaluation across the entire commodity spectrum. The deliberate suppression of interest rates over the previous decade distorted all traditional pricing. The market is now aggressively correcting those dangerous distortions through the mechanism of inflation. The target of $5,500 is not an overly optimistic dream. It represents a highly calculated probability based upon the trajectory of sovereign debt accumulation. Investors who recognize this profound reality today will certainly reap substantial rewards tomorrow.